Happy Monday out there, folks. This is Darius Dale here to present our macro minute for Monday, June 6, 2022. Starting with markets, we have stocks up this morning, commodities mixed with agriculture leading, crypto up, dollar down, global bond yields up. Shifting to our market moving headlines, where is consensus on quantitative tightening? So tech stocks and cryptos, which are the speculative darlings of the easy money era, are acutely vulnerable now that the Fed is shrinking its balance sheet. According to the latest Bloomberg MLive Pulse survey, almost half of the 687 contributors, these are buy-siders, sell-siders, et cetera, people who have Bloomberg subscriptions, saw that these are the two most risk-sensitive assets that are exposed to quantitative tightening. They're also, the consensus is also that it is seen lasting more than a year, while almost two-thirds of respondents said the 4-decade bull market in treasuries has ended. No comments there. Just wanted to help everyone understand where is the market on the sort of likely impact for quantitative tightening. We're not too dissimilar from our views, although I think we do have a little bit more of a draconian view on the likely sort of impact upon risk assets from what we believe will be a bigger than expected reduction in net liquidity. We talked about this in great detail in our Around the Horn and this past weekend, and also in our Friday's Lead Off Morning Notes. So definitely go check that out if you have not seen those reports thus far. Shifting gears. All eyes on Friday's May CPI release. The May CPI report takes top billing in an otherwise quiet week for U.S. data. Consensus sees headline inflation holding at 8.3%, with core inflation slowing to 5.9% from 6.2%. A monthly reading of 0.7% is expected. This is for headline. Fed speak is absent this week, as it's the blackout period for the June 14th to 15th meeting. So if you want to, markets want to take some, obviously we're off to a good start this week. If they want to take that and run with it, they're going to get an opportunity to take that and run with it again in this blackout period. But we believe, as we've been talking about since last Monday, that we think markets are sort of trapped between sort of call wall support of 4,200 and put wall support of around 4,000 or 4,000. Getting that information from our friend Brent Kachub over at Spot Gamma there. So go check out their service. Excellent service in and around OPEX. Big Vixbury as well next Wednesday as well. So blackout period. Markets want to grind higher. I think the likely path, we're already at the upper bound of the probable ranges for most markets, so it's unlikely we see a significant push higher from here, but there's no real reason to go lower in the absence of Fed speak. But we will get a lot of Fed speak, obviously, next Wednesday. And then lastly, the bull market and energy. But by the way, next Wednesday, we're going to get the updated summary of economic projections. We do believe those do have the ability to spook markets in the context of what has been some very aggressively strong still employment data. We talked about that in the Lead Up Morning Note this morning, so check that out if you haven't had a chance to review that. And then lastly, the bull market energy remains ongoing. Saudi Aramco raised July prices of its Arab light crude for Asian buyers by $2.10 per barrel. That's more than the expected boost of 1.5%. They're also increasing selling prices for all grades to Northwest Europe and the Mediterranean. U.S. prices were kept unchanged for the second straight month. That's probably a cap tip to President Biden, who's really extending the olive branch to the prince. To the crown prince to sort of help ameliorate some of the inflation pressure that we continue to see building here in the U.S. economy. Big movers here this morning. Emerging, as I've mentioned, is risk on day. MSCI Emerging Market Index up 2% to up 5% month over month. Bitcoin up 5% day over day to down 13% month over month. So again, risk on day to start a week that could potentially be very risk on. But again, we don't think we're going to get significantly beyond this sort of level from an S&P pricing standpoint into and through OPEX. That's next Friday, so be aware of that. And then we're back to the cycle after that. So if only you could have OPEX every day, you bulls. But anyway, shifting gears to our volatility adjusted momentum signals and probable ranges. U.S. dollar still bullish there. Sorry, my apologies. My pen working here this morning. U.S. dollar still bullish there, still oversold with the 1.9% of range to the upper boundary, 1.9% of space to the upper boundary of the probable range. Gold bearish fam still not quite overbought, but 3.2% of downside versus only 0.7% upside. 10-year nominal treasury bullish VAMPs in the middle of the probable range still, minus 20 basis points of downside versus 12 basis points of upside. High yield credit spreads. Bullish VAMPs here still at the lower bound of the probable range with 66 basis points of upside. S&P 500 bearish VAMPs still at the upper boundary is probable range with 8.9% of upside. People just getting chopped up. It's been at the upper boundary for a week now. People just getting chopped up back and forth, but we haven't really moved anywhere. So don't take the green on your screen today with the grain of salt, because we've seen some green, we've seen some red in the past week and a half. VIX neutral VAMs. Minus 11% of downside versus 27% of upside. You could see a crush in VIX start early next week into VIX-PRI. But that doesn't necessarily mean it's something to chase, particularly given that the VIX-PRI is will be at 9 a.m. But before we get the FOMC at 2 o'clock, and then obviously summer economic projections, the Powell press conference, et cetera, et cetera. We do believe the balance of risk from these prices here is very much skewed to the downside from a risk asset response perspective, because we believe the Fed is likely to come out a little bit more hawkish relative to expectations at the current juncture. Brainerd kind of reiterated that last Friday, that the market had gotten ahead of itself. So we expect more of that from Powell next Wednesday. But again, it's this Monday, so let's be aware of that if you're trading this tactically. NASDAQ 100, bearish VAM still at the upper bound of the probable range with 11.8% of downside. Russell 2000, same thing, bearish VAMs still at the upper bound of its probable range with 11% of downside. Bitcoin, bearish VAMs kind of similar to the NASDAQ at the upper bound of its probable range with 15% of immediate term downside. Ethereum, bearish VAMs, minus 17% of downside with 3% of upside. Shanghai Composite, neutral VAM, still grinding higher, wants to break out the bullish VAMs, 5.6% of downside to the lower bound of the probable range. I don't think we're going to get that anytime soon, just given our growth cycle dynamics in China, the liquidity cycle dynamics. Both of those are doing this, while the U.S.'s growth and liquidity cycles are doing that. Crude oil bullish VAMs, supported by the Saudi move, minus 8% of downside versus 4% of upside. Agricultural neutral VAMs bouncing off the lower boundary of its probable range with 5.2% of upside, only 2.4% of downside. And then lastly, industrial metals overbought as well, minus 6.9% of downside. So a lot of asset markets overbought, very clearly pricing in what they hope is the Goldilocks scenario, whereby inflation magically comes under control and the Fed can take its foot off the brake, over the near term, or at some point in the near term. Obviously, the September pause became the central anchor for a lot of market participants. But again, we disagree with that view. Our view on inflation is a little bit more sticky than I think the average investor realizes. Our view on Fed policy is a little bit more hawkish than the average investor realizes. As a function of that, we don't think we're going to get any Federal Reserve ambulance sirens anytime soon. And what I mean by anytime soon is over the next couple of months. So we do believe asset markets are broadly mispriced here and will ultimately start to reflect our macro views in the coming weeks post the other side of OPEX and the Fed. So with that, Darius Dale presenting our macro minute for Monday, June 6, 2022. Best of luck out there.